points now, 25,000. Sanjeev Prasad is our market master of the day. He's with us, Managing Director and Co-Head at Kotak Institutional Equities. Sanjeev, good to have you with us here. Thanks for your time. Some are making the case that maybe consumption has been in the doldrums, and these GST-related reform simplifications, if it is done in a meaningful way, can turn the tide. And within people, and if you look at the basket of people with that view, some say it could be a tactical move, some say it could be a really, durable one. First of all, do you believe it is possible? And how do you think about it? And where will this show up in a big way if this were to be a meaningful reform?
Look at what our government has been trying to do in the last 6-7 months. Clearly, the effort seems to be on reviving consumption demand. I think the government realizes that investment demand has been on the weakest side. And starting with the income tax cut, which was announced in the budget, you had then the RBI cutting policy rates by 100 basis points. And now you have one more action in the form of GST rate rationalization. So hopefully all these things result, some pickup in consumption demand. The bottom of the pyramid consumption has been really struggling given income challenges over there, and the fact that affordability has been a big issue. Prices have gone up a lot across the board. The whole idea is, to make things more affordable, and hopefully, companies pass on the full benefits of GST cuts to the consumer, which results in prices becoming or items becoming more affordable, and hopefully demand picking up. So that's what the government is betting on. The market has a slightly different take on this. The market seems to be assuming that most of the cuts in the GST rates, whether it is 28% items moving to 18% or 12% items moving to 5%, most of them will retained by the companies, which will result in a big increase in the profitability and profits, which of course means that you may not have that much of volume impact. So let's see, how this exactly plays out with the combination of profitability versus volumes. The common intent is very clear. It wants, the cuts to be passed on and result in high profitability and volume growth. Market seems to be taking a different view on that, so let's see.
That would be a bit of maybe a self-goal, won't it, Sanjeev? Hi, morning. Great to have you on, because we've seen that in the past as well, right? The benefits of lower commodity costs over the last, and I'm not talking Q1, but in general, we've had patches of reasonably decent, margin sustenance. The problem for the market, however, is growth. And on that, where do you think we stand at the end of Q1? Do you feel we'll at least get into double-digit earnings and maybe better-looking top lines by the time we get into full-blown festive season?
The growth challenges remain. It's been sluggish, and that is why the government is trying various things to revive consumption. Do keep in mind the fact that some of the drivers of GDP growth in the last 4 or 5 years, which was largely high-income household consumption and government spending and household spending, that is residential real estate, all these 3 items look like they could see some slowdown. Government Capex, we anyway know, look at the government budget numbers for FY26, that's the central government number, that's only a 7% growth. So clearly that's a big slowdown compared to the growth rates which you have seen in the last 3-4 years, particularly FY2020 to FY2024, where you had massive growth in railways and road spending, etc. Given the challenges of weakish sentiment in the IT sector and also especially spreading to the GCCs, and given the fact that residential real estate prices have moved up a lot in the last 18-24 months, I would expect household investment, that is purchase of residential real estate, that should also slow down. Hope is, somewhere you'll see some revival in consumption, which balances out the slowdown in investment. Exports is anyway, a big challenge as of now, given what was happening on the geopolitical front, as also on the whole trade tariff issue. So with that background, I don't know. It doesn't look like you will see a big acceleration in the economy. The hope is somewhere in the festival season things start picking up, but let's see.
So numerically, Sanjeev, I didn't quite get the range. So numerically, now that Q1 is over, where are you with respect to full year earnings estimates?
So we are about 9% now, 9.5% to be precise. But the quality of earnings growth in FY2026 is not great. I'm talking about Nifty 50 index. More than 60% of the incremental profits are actually coming from 3 sectors. and which really don't have much to do with the economy also, to be honest with you. So if you look at about 20% is coming from the metal mining sector. That is largely on the back of improved profitability for the steel sector, on the back of safeguard duties. Then you have the telecom sector, including Reliance, which is going to contribute to incremental profits based on the expected increase in tariffs somewhere in December, January timeframe, and the fact that you're seeing the full benefits of the tariff increase last year, that is playing out now. And lastly, you have ONGC also, which is contributing about 20% of the incremental profits. That's more to do with the gas price formula. So the nature of the incremental earning growth is not a very good quality. It's not as if we are seeing some big recovery in the economy, which is resulting in this 10% earning growth. Hopefully that will play out in 2027, but that remains to be seen. As of now, the growth trajectory for the broader economy itself is looking a bit challenged, I would say.
As you said, 9% Nifty earnings growth for FY26, right? That's your estimate.
Yeah.
Okay, got that.
Hi, Sanjeev. Good morning. Good to see you, Ben. Sanjeev, what according to you is the message that the government is sending out? In the budget as well, the focus is on putting money into the hands of taxpayers, more money. Even now with the GST cuts as well, they're indicating they're focusing more on the consumption story. While the Capex expenditure, that seems to have taken a bit of been put on the back burner. No big increase this year. You have big elections as well coming up. What is your view on this? This is the government that actually was, ramping up on the Capex side. Now that seems to be turning a little bit. Your take?
Yeah, I think the government realizes that it can do only that much with respect to investment. Particularly if you look at the central government, there are three areas where the central government can spend dramatically. One is defense, second is railway and roads. The challenge over there is if you look at railways in particular, your expenditure used to be about 680 billion rupees or so in FY 2020. That has already gone up to about 2.5 to 2.6 trillion rupees by the time we hit FY 2025. A lot of low-hanging fruit on the railway cap is already done in my view. And what I mean by that is electrification, which used to be, sub 50% about 10 years back, that has now crossed 90%. You have put in a lot of safety signaling systems and so on and so forth. On the back of that, your average railway freight and passenger rate movement, that has gone up. On the back of that, India has already ordered a lot of rolling stock, coaches, etc. So I think as you're hitting some sort of a peak with respect to the capacity utilization of the current railway network, which means you will not probably see a big increase in capex on railways. If you look at roads, where you are seeing a similar growth, of similar 680 billion rupees in FY 2020, went up to about 2.4, 2.5 trillion rupees by the time we hit FY 2024. I mean, India has already a very decent, highway network, right? Intercity network is actually quite good. So you will see a natural slowdown over there. And I think the government understands that it can only do that much. Where India needs to put in more money on the capex side is the intra-city infrastructure, a combination of, urban housing, mobility, and water. Of course, the states are constrained, given the fiscal challenges, etc. And institutional capacity is also a bit weak over there. So I don't know, it looks doubtful that government capex is going to accelerate. Just to give you some data, if you look at public sector plus government spending as a percent GDP, that used to be about 6.9% of budget in of GDP in FY 2020. That went to about 7.9% by the time we reached FY 2024, which means that it was going much faster than normal GDP growth. But that's about it. I think we are flattening out over there, which means the government has to try something new, which is basically the extra focus on consumption for now. In the meantime, we are still waiting for private capex to pick up. That's been sluggish. It's been in the range of 11% of GDP for the last several years now, and no signs of acceleration over there. So I guess the government is trying whatever it can. It knows that its own spending on capex is going to be limited going forward. Private capex not yet picking up. So let's try whatever we can do on the consumption side.
Got that. You got a call on Sagility, Sanjeev, this morning, I believe, right? Do you want to just take us through that? Just the thesis?
No, it's initiation of 3 companies in the BPO space, actually. So it's got nothing to do with specifically with with agility. So we have three company initiations, agility with the buy, first source with the reduce, and influx with reduce. Yeah.
Yeah, but out of the three, there's only Sagility which is a buy. Hence, I was asking about that. Yeah, target of about 56 or so. You mentioned a few names, Sanjeev, but out of the coverage universe, as you look ahead, right? When clients ask you for ideas, what do you tell them in terms of single stocks? Really top of the list, absolute return candidates from here.
A few banks, the tier one private banks, couple of tier two private banks, some of the domestic pharmaceutical companies and healthcare services companies, which are hospitals and diagnostics. A couple of names in capital goods, but that's about it. That's been our model portfolio anyway for the last 12 months or so. Yeah, nothing has changed over there. Continue to be pretty negative on consumption, on IT services, given the combination of very stiff valuations and not much of growth for now. So nothing has changed really in terms of our view when it comes to the market or to stocks.
So on consumption, just to wrap it up, Sanjeev, why is it that you're not at all optimistic of any sort of a revival on any element of consumption? I mean, whether it is premium, mid, lower end, because of what you started off by saying, that companies will probably pocket the benefits of this GST cut. Is that why?
Well, I'm not saying I'm not positive on consumption. I'm cautious on consumption. The hope is it will recover gradually from where we are, but it's not going to be a massive recovery. Keep in mind the fact that India is simply not creating enough number of quality jobs, and we have written enough on that. You look at the government's own PLFL's data, most of the incremental workforce is ending up in agriculture or in the gig economy, where of course income is not going to be very high. So that fundamental structural problem still remains, and for that we need private sector investment to really pick up for jobs to be created on the back of that, incomes to grow and consumption to really take off. I mean, we are nowhere near that cycle to start. The bigger problem with consumption is not so much whether it will recover or not recover, it's just the valuations. Even assuming if you see a big recovery, there's no way I can justify 45 to 55 P, which is where most of the consumer stable companies are trading at, with the kind of growth rates they're reporting, or even with some acceleration in growth rates. Even if they go to, let's say, mid-single digit, high single digit, I mean, there's no way you can justify 45, 50.
I think, Sanjeev, the market is hearing you very closely. And the market's now giving up some of its excitement of earlier in the week, because as we are speaking, the morning is looking a bit red, 128 points lower on the Nifty. But yeah, we take your concern on board. And I think we have to see how the next couple of weeks and months play out, and if indeed that consumption boost comes through or not. Thank you so much for joining us this morning. Thanks very much. Great conversation.